Good Tuesday, everyone. I am David Salem, Managing Director of Capital Allocation here at Hedgeye, and delighted to be diving into a conversation with a gentleman that I very much respect. My good friend Ted Oakley has come up from Texas to chat. Ted, thank you for making the trip. As we were just noting, I'm the guy from New England, and I'm wearing cowboy boots, and you're wearing shoes that more befit New York City. So here we are. For compliance and many other reasons as well, I'm going to label this session as one in which we're going to help people learn how to fish as opposed to handing people fish. So we're not going to mention specific tickers, probably none, but there may be a few that come up from time to time. But Ted has vast experience, deep experience, broad experience in the money management industry, and I really admire the frameworks that he's devised and the way he goes about the profession, as I like to call it, of money management. So we're going to come back to your background, Ted, which is quite distinctive a little bit later on. But I want to just dive right into the process of teaching people how to fish by asking you at the outset to discuss the distinction that you draw between base capital and investment capital, if you would. So why don't you get us started?
You know, David, we started that years ago where we felt like that what happens with investors is they don't realize, but there should be part of their money that is somewhat untouchable in terms of volatility. And the reason for that is because in those periods where you have extreme volatility on the downside, you have to have something emotionally that can keep you settled down. When you have everything in one spot, one area, where you don't really have a lot of what I call base capital, I'm speaking money that you can get your hands on readily, you know, stuff that's within 24 months probably, treasuries, that sort of thing, high level. But when people don't have that, they don't have the ability to emotionally walk through the tough times.
Yeah. So why don't you take us real quick overview of the business that you've built. It's quite impressive what you've done over the course of your career. And you can, in fact, I'll encourage you to go all the way back to your humble beginnings and origins, because I think it informs the way you go about helping your clients steward their own wealth.
Well, I grew up poor, very poor, and there's nothing wrong with that. I mean, I had love in the family and that sort of thing, but there certainly wasn't any money, and it was as hard a time as probably anybody ever had. But I was really fortunate along the way. I had a lot of people that really did a lot of great things for me. I educated myself. And 40 years ago, I started a company with Mr. Plant and Mr. Herndon, and we still have that company. It's a different company. We still have that company today. They're great partners. And then Oxbow was spawned out of that, which is a different company, a money management company. But one of the things you find in growing up poor is, and it's interesting, this is why I developed base capital, investment capital. I did it for myself. Back in the 30s, I was so poor that all the money I would get, even when I was in the business, I would be too conservative. I would hold it close and not have, and now realize, you know, I have to have two sets of money here. I have to have this money over here. This is for myself.
Yeah.
And then this will be my risk pool over here, which is a bigger pool, obviously, but it's still, you need the other. That's how I really developed base capital, investment capital, was back in the time. But we started 1983 calling on people all over the United States that sold companies. And that was, number one, we love business owners. We love the way they think. We love, particularly first generation business owners, have been really that's our bread and butter, and that's how we developed assets through those people over the years. And they think like us, we think like them, and in most cases, not everyone, but that's how we developed through the years.
I want to come back to this important difference between first generation company builders and second and later generations in just a minute. But before I do that, maybe Eric, can you put on the Ashwin Chabra framework, the one with the Eiffel Tower? I just want to get Ted to comment on it. I've shown it from this room repeatedly, as you know, Ted, and I gave you a forewarning of this. So Ashwin, who's running the money for Jim and Marilyn Simons now, their family office, has a tripart dichotomy, a tripart framework.
Right.
It's not a dichotomy, but which is on the screen. And you have a sort of a two-part framework, and I'd just be interested in your briefly comparing and contrasting the two. Are they more similar or different? Is this what you're trying to get at in encouraging your clients to think about base versus investment capital?
Well, it is, and you could take the investment side of our capital and it could be a two-part or three-part because we do different things.
Yeah.
But, and so we don't break it down like that. But just from terms of where we are, now one of the things I've found out, one of the books I wrote, The Psychology of Staying Rich, I interviewed quite a few really wealthy people, 500 million to over $1 billion.
Yeah.
And one of the things I found about them is they had base capital, and they knew when to use it, and that's interesting to me. So people with smaller amounts of money could remember that.
Yeah, so talk about that a little bit more, because for most of my career, I think until quite recently, and I've talked about this and written about it at some length, you have the adage, cash is trash, right?
Yeah.
And I know from your writings and from separate conversations with you that the base capital that you just alluded to, A, constitutes a relatively large fraction of those uber wealthy people's investable wealth. And B, if I'm not mistaken, and I want you to comment on it, it's often held in cash, which is not at all what you see with longer term institutional endowment and foundation asset mixes. Anyhow, discuss.
Well, everyone I talked to of those kinds of people, number one, they all had real estate too. It just seems like it was not every single one of them, but most of them had a fairly decent piece of real estate, 30-35%. And then on the cash part, they all had the same idea. I don't need to hit the first ball that comes at me. I can wait. I have enough money to where I can wait. And they all said the same thing, that we know that every decade we're going to have one or two chances to really make a lot of money, because we will have liquidity and nobody else will. And that was basically their format for thinking that way. And if you think about it, it works out that way for them. They have liquidity, and that's where they really get ahead of everybody else, through that.
Do you want to try to contrast that with what you've typically encountered when you've dealt with investment committees acting as such?
Well, I have to say I don't do real well with investment committees in this respect. I think I mentioned this to you, but if it's an annual change of committee members, okay, that means we have to educate the new ones, and typically, not always, but I'm not saying this is a total case, but many times you have a new person coming on that wants to let you know on this investment side that they know what they're doing and that you may not be going about it the correct way, of those sorts of things. And so I try to get, we've done that though, I've tried to get those people to think a little differently than the normal investment committee. I've actually tried to get them to think, don't try to be sort of a lemming approach here. Try to think about what could go wrong, okay? And what do you really need? If you ask them, in most cases, about inflation, net inflation returns after inflation, very few of those people could answer that question for me. They didn't really know the number. And so they were used to people making a presentation, this is what you should do, this is what you shouldn't do. I've really tried to get them always to think about what they're doing. Can you really think about it?
Yeah. It's interesting that you say that, Eric. I think there's a slide in the deck that I gave you for today. It may be, in fact, the very next one, which is called Getting Structured for Success. Yeah, it's a lot of crowded words here, Ted, but as you know, it opens with what I call my real return swap question, where I will deal with asset owners, whether it's an investment committee, a family office, a wealthy individual, and ask them, okay, if you could swap all of your investable wealth for a risk-free contract that would guarantee a real return, a return net of inflation, what would be the threshold level at which you'd say, okay, I'm willing to forego anything better than that in order to be assured of getting at least that return? Presumably, this is the hypothetical question that I pose, it's on screen at present, over an indefinite time horizon. I know that you pose something similar, that kind of a question to your clients, both actual and potential. What are the range of answers that you've gotten, and what do you deduce from the answers that you've received?
Well, first of all, I'm trying to get them to understand that the idea of investing over the years is to maintain buying power. That's the idea, is to have as much money 20 years from now as you do now, plus maybe make more than that. And so one of the things I ask them is that very question, look, if I could just guarantee you a rate of return over inflation, what would you take? Most of them don't have a clue on really what to do, what to say. I mean, I've had people tell me, oh, well, let's shoot for 12%. And I'm like,
Net of inflation.
Yeah, I'm like 12%.
So they clearly have no understanding
No idea.
of capital market
No idea.
history.
And so I try to explain to them, I said, just look, look at the history back to 1900. Let's say that, the new book, Stocks for the Long Run, he said that that's maybe an 8.1 or 8.2 nominal, 3.7, 3.6 inflation over time. So where does that leave you? And so you have to start with them to say, okay, if let's say we're going to go more on the, what do you want on the base side, fixed income side? You're down to maybe 1 or 2, maybe at the most. And then the other side, you have to sort of get them to understand. If you just ask them the raw question, though, David, most of them have no idea. If you just ask the raw question and don't give them any input, they don't know.
I'm going to propose a very unfair question. Like, I know your wife has a very senior post at the University of Texas. If you had like unilateral control over their large endowment, and you were posed that question on behalf of the university, what real return would you accept on behalf of the university to lock away its endowment forever in exchange for that real return?
Okay, one of the things about them that's different from most is they have a lot of oil and gas coming in no matter what.
True.
So it just piles back in. But if I were sitting there, okay, in sorts I couldn't be because I didn't go to UT. But what if I were sitting, you have to go to UT or A&M. And so if you didn't, but what happens is, if it were me and I were sitting there and I said, look, if you could give me, okay, if you give me a 5% run over inflation, I'll hand it over to you. We're done for good. That's me. That's what I would say.
But anything lower? You wouldn't settle for
Well,
it?
no, I might. I'm using the best case scenario now. If you said guaranteed, okay,
that's my hypothetical.
probably I would probably in that case say, give me 3.5. I can go with that.
So in the process of answering my next question, I want you to give us a little more color on the shape of your business, and specifically, among other variables you can discuss, the split as between taxable and tax-exempt wealth.
Right.
The question I'm leading to builds on the question I just posed about UT, which would be, that's tax-exempt capital, their endowment. What about in the case of a high-income taxable family or individual?
Right.
What real return swap would you accept there? And again, I encourage you to describe your business in somewhat greater detail, the size of the AUM and the split as between taxable and tax-exempt. Because I presume, Ted, that you and your team are managing the taxable wealth in a manner that necessarily differs from the way you're deploying tax-exempt wealth.
You do. One of the things about the taxable wealth is we obviously have a tax aspect we have to take into consideration on the thing. And one of the things we do that's probably a little different from most people is that we try to own our companies for more than 5 years. If you look at our average, we have holdings that we've had for 15 years. But that's when we're dealing with money that needs to stay with. One of the things I found out, a lot of people when they invest, they turn too quickly, so they end up giving it away. And a good company, they may get up on it 25% and sell it, and look up 4 or 5 years later, and they left so much money on the table, that sort of thing. But for us, what we do in those situations is we try to think about, okay, well, first of all, if they're out of state, okay, now Texas doesn't have an income tax, but we hold only treasuries for the no state tax situation. Amazing how many of those people don't know that. They'll have money at the bank, and so we make sure they understand that to start with on the liquid portion of it. And then we're pretty good bond buyers for the portion that we do have in fixed income. We're good at that, and we don't try to. What we're trying to do there is it's just an offset for the other side of the investment. We only have really 3 strategies, and the people like that. But we have a really conservative fixed income, and we have a stock side on one side, and in the middle we have something we developed in '92 called a high income strategy. There's no bonds. These are things that pay high cash flows, and most of our investors, including high net worth, they want the cash flow without having to be totally in the stock market.
Mm-hmm.
And if you look at the volatility level of that middle account, it's probably only half what the stock market is. Sometimes, you know, it doesn't work as well. I mean, people you get a high return in the stocks, and you don't get as much on the middle side. But what we do in there is our process is trying to hold things long enough to where we're obviously in the low bracket. Or we'll own things, like if you look at a high income account, we own a number of MLPs that are paid on a K1, much like real estate, that kind of thing. But that's the way we approach it. I know it sounds relatively simple, but they like it that way. So that's sort of the way that we run the three strategies.
Yeah. Now you're, I know, quite familiar with what we do here in our research and the way we look at the world at Hedgeye. And I say we, all due credit to the many people sitting behind us right now, because I'm a relative newcomer to the whole exercise here. But you know that we tend to look at gold as a currency, and you, I know, have a heavy emphasis on the cash generative properties of anything you put into your client portfolios. Does gold have any role to play? I presume that it doesn't have a role to play in the first conservative income strategy because it doesn't generate a cash flow. But talk to us about gold.
Yeah, oddly enough, it really does. In the conservative income strategy and high income, we own 4% gold both. Okay, we don't own gold in stock accounts.
Yep.
However, we do own a couple of royalty miners, not the gold itself, because we want the cash flow on the upside, but we didn't want the capital expenditure. So, but we own 4% in both of those, and we own it because we feel like there's periods, and we think we're coming into one, where gold will come into its own again. You know, I don't have this with me, but I've done a pretty good study, and I've really worked on this year about showing these 15-year periods where finance does well and commodities do well. Yeah. Well, we're coming up on one. Now, I'm not saying it's going to happen. I'm just saying I can block it out to you going back to, you know, the 1930s and show those 15-year breaks. And we haven't had one in a while. So if we get that, gold should do well. But I look at it as, I'm looking around in the world right now. And if you look at the world right now, all these countries buying gold. They're buying gold. And I know it's going to be very hard for them to try to get some sort of currency against the dollar. I understand that. But I think one of their objectives is, I want to own something else besides the dollar.
So if we think about your overall AUM, what fraction of it, very roughly, is invested in shares of companies domiciled outside the United States right now?
Very low, 2%, because a lot of the companies we own are 50% world anyway.
Yeah.
You know, I think people have to look at that. I mean, you can say, now, we have been looking at a few Japanese stocks, but if you look at the companies, a lot of the companies we own, though, so much of their business is worldwide. They just happen to be domiciled here, and they're U.S. companies. But, you know, that wasn't the case 40 years ago.
Yeah.
You were just here or there.
Yeah.
And now it's different.
Yeah.
You know, they're integrated all over. So I'm not saying we wouldn't do it or anything like that. It's just that things have been so poor overseas, we haven't had an interest in it. Yeah,
well, let's talk about investment policy statements. I want to have a logical, in my own mind, maybe it's a warped mind, but a logical segue from what you just mentioned, and ask the question, to what extent are you emphasizing the crafting of investment policy statements and trying to codify what your clients want and what you think you can deliver? And more specifically, Ted, to what extent are the clients expressing preferences, if not strict limitations or exclusions, as you discuss these policies with them? I mean specifically with respect to China in particular.
Yeah. Well, I'll tell you, when we talk to somebody about an IPS, you know, what happens is they've usually seen just a black box piece that's been shown to them. They're all, you know, all the sort of the same, like, and maybe the people before us were there or something like that.
You mean sort of boilerplate?
Yeah, just boilerplate. And so what we try to get them to understand is, it is all right. You need to have this in there. I'm not saying you're going to do it tomorrow, but it is all right to not be that exposed to something, or potentially be zero exposed to something. And you need to have that capacity in there. And you also need to have the capacity
Meaning you don't have a non-zero minimum, as I like to put
Right,
it. You can
right,
say
right. You
it's
can
okay
say-
to go to zero
You can
on
go
a
to
given
zero.
exposure.
And you can go, and, you know, if you want to own liquidity, so many of the ones we see, and that's why I think we don't do as many public accounts, and that's the reason why, because it's a lot of changes going, a lot of things. But I always recommend to them, you know, I'm on the boards of a few of them, and they don't have any, they don't listen to me, but they don't have any cash.
Why not?
They don't have any cash. They're like 1%, 2%.
Yep.
And I'm like, okay, wait a minute. You have 1 or 2% cash and you have 35% in alternatives, and you don't even know what they are.
Mm-hmm.
So you try to educate if you can, but I think to a certain degree, peer pressure affects these people.
Yeah.
And they know, you know, they sit on maybe multiple boards or know somebody else. So what we try to do, there's some policy statements where I say, look, we're going to take your policy statement that you already have, and we're going to recommend to you to make some changes here.
Yeah.
Because you're in the wrong place here.
So again, I'm going to try to draw a connection that you may deem inartful when you hear me try to draw it. But I want to draw a connection between what you just said and your allusion at the beginning of our conversation today about first generation wealth. Because I know you've thought and written a lot, very eloquently in my view, about both the benefits and the burdens of second and lower generation, lower not in a pejorative sense, but second, third, and subsequent generation wealth. The mindset, the segue will be, do you find that when you talk about, for example, the importance of having substantial cash reserves, of not keeping them at a de minimis level, of knowing what you own and owning what you know, do you get a different reaction and response from first generation company builders and founders versus second and third? And in answering that question, I would love to have you, whatever length you want, we've got plenty of time, expand on your views of the benefits and the burdens of the second and subsequent generation.
Well, that's interesting you say that, because there is a complete breakdown between the two. The first generation, who probably had to scrape, probably went in debt, probably had nothing, barely had to make payroll, everything. They understand the ability to hold cash and to be more conservative. They're fine with it. We rarely have one that's not fine with it. We do. What happens with second generation, unfortunately, is they didn't make the money. And you know, I just finished an interesting book called The Missing Billionaires. And it goes back to say, if you had $5 million in 1900, it would have spawned, if you just got a normal return, you didn't need to beat the market, you would have 16 billionaires out of that 5 million today. And they went back to say in 1982 Ford's 400. There's hardly any of them made $1 billion off of that. And so what I'm trying to say is, when you get to those seconds, and here's my problem with it, is that it's hard to get second generation to listen well, because I feel for them, I do, because most second generation wealth, okay, is trying to, or third, is trying to be relevant. They're trying, and they're good people, but they're trying to be relevant relative to the first generation, who, let's face it, was the matriarch, patriarch of the whole machine. And so that's a very hard position to be put into, but they're in that position. And it's interesting, I have a new book next year coming out on that. I know it'll be a little bit controversial, because some of the second and third generation won't like it, but the point I was trying to make to them is this: it would be very helpful for you in the investing side to listen and learn to stand on your own 2 feet, and you don't need to try to show anybody else what you are. Okay, I'm getting into some family things here, but that's what happens. I see that. I see it, and it's not always that way. I mean, we have some really great second and third generation investors, I will just tell you, but many times they want to just be going, get that money in, get the money in. Don't, you know, let's try these other things. Let's try all these alternatives. And many times they don't really know. But And not all first generation, but first generation people have usually lost money already in the business or something. So they're reticent to just do anything, you know. And so they know they're okay now. They spent all that time building a business, and so they think, you know what, I'm not going to ruin that the rest of my life. But it's rare. It's for us, even in our own business, it's rare for us to get those concepts over to our second and third generation. I will tell you, David, they spend the money.
Yeah.
They just spend it, and it's hard to get that across.
Yeah. Didn't you write a book? Was it 20 million and gone? Or what?
I wrote a book called 20 Million and Broke, and it's a new version of it. Actually,
Yeah.
has just been finished. I finished it this month. It'll be out in February, called 30 Million and Broke. That was 15 years ago.
It's
so
just inflation.
It was 30 million, but plus I had some more stories.
Yeah.
I had some more stories of people that.
Any you want to share with us right now that are in the new book, in the forthcoming
Well,
book?
yeah, since that time, okay, I've had 250 million people that went to zero, not because of us, because they went outside and did all the things we tell them not to do. I've had 500 million people lose 80% of it, you know, and so. And numerous,
Yeah.
30
But you're
and
not
40.
alluding to profligate spending, and maybe that was part
Oh,
of
no,
it.
they
this is
went
just
into business.
Failed
No.
investment,
They did all the things you wouldn't want to do.
poor capital allocation.
They would own too many homes, buy too many jets,
Yeah.
invest in 6 businesses they had to feed all the time, that sort of thing, and not thinking about the ramifications of it all. It's interesting to me, most people don't realize, they don't take serious enough how much it takes to get after-tax money at that level. It's hard.
Yeah, yeah.
And you can't do it a second time usually.
Yeah, approaching impossible, really, yeah.
Yeah.
Eric, can you put the first slide up on the screen? I want to ask Ted to talk a bit about a somewhat sensitive topic, which I think you're familiar enough with what I've been able to share with the audience here at Hedgeye to know that with respect to almost any aspect of my professional life, I have a 4-part framework where I start with disqualifying attributes, and then unfavorable, favorable, and then highly attractive or essential. And we're putting this on the screen only because I want to show that framework and ask you to describe. I know you're rather discriminating about the families and individuals that you're willing to manage money for. What are the disqualifying or unattractive attributes that you have in mind when you're talking to a potential client and you ultimately decide to, no, I don't want to work with them?
Well, the number one is they have, their expectations are not realistic. Their expectations are, I want to beat the S&P every year. I don't care how you do it. That's what we're going to do here. And I'm like, well, we can't do that.
Can anybody do it?
So we'll start off with that for sure. And then secondly,
does that end the conversation?
yeah, no, pretty close. I mean, I'll go through it with them, but and then and another thing that they want to do, for example, is I want to be involved in the decisions.
Yeah.
And we're like, no, you can't. We won't do that. Okay, either because we know it's just not going to work, and so
So it's all fully discretionary.
that cuts it.
Yeah.
I've had people tell me this before, as crazy as it sounds, but they'll say, I don't like to take losses, so I don't want you to take losses. And I always ask them a question and say, or the statement to them, if you're doing business with somebody that won't take a loss, then you need to fire them.
Yeah, for sure. Yeah.
But people, they think that though, especially second generation, by the way.
So
And so
I've never heard that actually.
No, I've had second generation tell me, you know, we didn't get here by taking losses. We got here by taking. So I don't want you taking losses. I said, yeah. Well, I'm like, well, you just put me in a position. You might as well think I'm God, because that's never going to happen. And so those are things. And then if we get in a situation where I can tell there's tremendous conflict on expectations between the 2 spouses. One's really conservative, one's really aggressive. We won't take it.
Yeah.
And
you can see they can have a very happy marriage. They just happen to differ on that
and
one
it's
dimension.
just somebody is always going to be unhappy.
Yeah.
and guess who they blame?
Yeah.
I mean, that's what's going to happen, because they're going to say, well, you know, they're real risky. I told you not to do that.
So this takes me to, Eric, if you could go to the third slide with the real return swap question on it, because there's a second question on that slide, which you may recall seeing, Ted. It's the drawdown question.
Yeah.
Right, and it's, you know, it's in every RIA's questionnaire of a potential client, right? How large a drawdown are you willing to tolerate? I wonder what you think of the question, and I wonder what, more importantly, what you think of the answers and how you relate them, if you can indeed get the chance to do so, to the real return swap question. Because I've always regarded them as kind of logically opposite sides of the same coin, and when you get wildly, illogically inconsistent answers to these two questions, that's when I say to a potential client in my former life, no thanks.
Yeah.
I don't want to work with you.
Exactly. Well, I have to say that the way we do things, we're not going to take any extraordinary drawdowns. I would say on the whole, that would be limited to 15% at the most. On the whole, okay, on the whole. You'll never see us in that position where, like in 2003, the market was down 53 or 54% or something. We're never going to be in that. Our people can't take it, for one, okay? So we're never, and usually it's not that much. But I'm just saying the way we're structured, it's not going to happen like that. But what I find with people is interesting is they don't know themselves, David. If you say, I've been saying this before, but if they say, okay, I'm really conservative, and so you go through some things with them, you realize that I know you've heard this before because you've been around, you've run too much money, but it's I have this saying, they want 10% with no risk. And we're like, well, we can't. Yeah, we can. But they get around to that in some way, and then then you'll have somebody say, I'm really aggressive. But if you start asking the right questions and use absolute dollars, they've got $100 million.
Yeah, don't put the question in percentage terms.
Put it in
You've
dollars.
got 100 million. What if you came back 2 years from now and had 50?
Yeah, and 50.
Yeah.
Or 60.
Yeah.
How are you on that? Well, I don't want that.
No.
Well, then I pull out some historicals and say, well, you would have done that here if you fully in the market, and you would have done it here, and you would have done it here.
Yeah. Not to dwell on it too much, but you mentioned that, you know, in a conversation with a potential client, I assume it was a potential client, they said, you know, I want to keep up with the S&P 500 every year. That's what you said. And we both kind of rightly kind of scoffed at that and said, that's not a client we want to work with. Right? But that begs the question, an important question to me these days, which is the S&P 500, you know, a suitable benchmark for any part of a large family fortune that the family itself hopes will endure for multiple generations to come?
Well, I know I'll get a lot of flack on this because they're going to be able to say, well, if you went back, you know, in the last 15 years with the S&P. Now, I would say this to them. Between January 1 of 2000 and 2012, I think it made 1%.
Yeah.
I may be wrong.
Yep.
But in this last period, this last 12 or 13 years, they've been able to say, yeah, you just got to buy the S&P and forget about it. My contention is that we're probably going into a period like 1966 to 1983, where, yeah, you can own the Dow and you can own the S&P, but guess what? At the end of the period, you didn't make any money. And I keep saying to these people in our business, you know what's going to happen? Somewhere along in there, 7 or 8 years into that, they're going to say, oh, it seems to me that you're making about as much money as I am.
Right.
And see, then the pressures come into the industry.
Yeah.
And so I think we could be going on that. If we are, we have a whole set of people that are totally locked into indexing, and it's going to really throw them.
Yeah, and I can't remember whether it was this morning or over dinner. I had the great pleasure of your company for dinner last night along with Kevin Peel. But you mentioned this sort of generational divide. You were dividing the kind of universe of actors and doers into at least 2 generations, but I may misrecalling. Go ahead and speak to that.
No, that's right.
Yeah.
What
was the framework that you...
Well, the framework was, I've said this all along, and I ran the numbers on this a year or so ago, that since 2009, about something like 42% of the people in the business have been only in that period. They've just been around since '09.
Right.
So,
Post-GFC.
yeah, post-GFC.
Yeah.
Then you've not another set of people that have been around 30 years, but they've only seen interest rates going down.
Yeah.
See, even though they've been around a long time.
Yeah. X the last 15 months.
Yeah, unfortunately, I'm old enough to say I've done both. I've gone
Well, you don't look it. You look
and
great.
so what happens is these people, especially the group I mentioned since GFC.
Yeah.
I think they're gonna have, and it's interesting. I interview people that are with other firms, or we're maybe looking at somebody like that. And it's interesting. I say this, but many times they can't really distinguish the difference between a balance sheet and income statement like we would do, but they're all about indexing. Just buy these 15 indexes and we're going to be good to go. And you put a certain amount in each one. Well, that was great. It did work during the period. I'm not saying it didn't work, okay?
Yeah.
But if you go into something different, and I always worry about, this is what I worry about for myself. Can I recognize the change? Can I recognize, is it going to be changing and I'm stubborn and not make an adjustment? Or is it changing in front of my eyes and I change too early? You know how that is too.
Yeah.
And so one of the things I like about your new program, which by the way I think is excellent, and I bought a lot of research, is the way it's done really helps with those changes. That's really good.
Thank you. I appreciate that. Those are very kind words. I'm going to actually, on that theme, I'm holding in my hand a client letter that you wrote, which I have the privilege of having in my files. I'm just going to read from it quickly and then have you comment on it. People in today's market are buying what is going up with no regard for value. Everything that was taught or learned by most of us money managers about value is now old school. As we go forward, the risks seem obvious to us, but as yet, few seem to notice. A change in investment themes is probably starting, but has yet to fully emerge. Hopefully we can get through this roller coaster time in good fashion. You recall writing those words?
I wrote that in January of 2000, yeah. And,
which I'm reading, of course, because it might aptly have been written today.
Well, fortunately for us, for the whole 3-year period, we were only down a little less than 10%.
Yeah.
So we didn't have far to make up.
This was 2000, 2001, 2002.
Right.
Yeah.
There was a tough period, and that period where I wrote that was very similar to today.
Yeah.
In the Magnificent Seven.
Yeah.
Like they'll never go down.
Yeah.
And in the front of that piece, I put 15 companies in there, and they got slaughtered.
In January, your client letter,
January
written
2000, I wrote out the companies,
yeah.
and they got slaughtered over the next 10 years. When I say that, I mean 60, 70, 80, 90% declines.
Yeah. This was Intel, Cisco, Microsoft.
Yeah. Even Microsoft.
Yep. Clobbered.
Yeah. I mean, it's a darling today, and we own some of it.
Yeah.
But it's had two lives.
Yeah. Big negative total return for the following decade.
Exactly.
Yeah. Yeah.
And so what I found was what's analogous is that people today are very, very similar. They assume that what they're buying in that will be fine.
Yeah.
And yet they never really look at what's under the hood.
Yeah. You've given me another great segue. I forewarned you this morning that I wanted to borrow from Tyler Cowen, who does one of the better podcasts that's available. I think he's superb. One of the reasons, by the way, is he's able to pose questions to his guests that are far more concise than the ones I'm posing to you today, which I really admire. So I'll try to hew to that standard for the remaining 20 minutes that we have. But he has a little segment in many of his episodes where he does an over and underrated. He just mouths a couple words and then asks his guest, okay, is that over and underrated and why? So I'd ask you to do it. The segue is, the first one I want to give you is the efficient markets hypothesis, EMH. Overrated, underrated, and why? And then I might insert my own evaluation. Yeah.
Well, it's overrated, in my opinion, because it's academic. And what I found about academics, and nothing against academics, okay?
Your wife works with
my wife is at the University of Texas, so I have to be careful, but because they're great people. But what you teach and what you put in practice are two different things.
Yeah.
And it's interesting. Most of the really great investors around that I've noticed are not big fans of EMH.
Yeah, yeah. I'll just say, as a hopefully entertaining and amusing sidebar, when you walked into the building today, as you know, I was tied up in a Zoom talking to some incredibly sharp folks from your home state of Texas. I probably shouldn't name who they were, but we talked a lot about options and volatility.
Right.
And I said, you know, I'm old enough to remember I had the great fortune of spending, having an extended conversation with Fisher Black before he died. And I remember distinctly asking him, you know, so what do I, starting my career, I was still a young man with very little experience. What do I do with your model, the famous Black-Scholes model? He looked me directly in the eye and said, well, David, it's not intended to be used in the real world because of all the assumptions that it's based on, which are kind of not realistic, which I thought was incredibly gentlemanly of him.
I always wanted to meet him.
Yeah.
He had passed away, but his wife was next door to us in Wyoming.
Oh, okay.
And really nice lady. That I've met her a few times, but I never got a chance to meet him.
was
But
such a
I would have
gentleman.
thought that.
Yeah, but anyhow, if I can say so, just between you and me,
Yeah.
the punchline is, a couple of years later, I was at the wedding of my assistant from work, and the family was kind enough to put me at the table next to Myron Scholes, who was a family friend of
Wow.
ours.
Okay.
And I posed the same question: what do I do with the model? And he looked at me and said, well, you do exactly as the textbooks say. It works perfectly.
Oh, wow, interesting.
And I thought, it's such an interesting reflection on their two characters.
Yeah.
Right? 'Cause this is before Myron and others blew up with long-term capital
yeah.
management. Maybe in hindsight, you can see that there was a kind of stubbornness that the model will always work as designed. Okay, next on my list, Jay Powell, underrated, overrated, and why?
Well, he's completely overrated, much like all of them have been since Greenspan, really. I think that these Federal Reserve presidents chairman, that think they can actually control the economy bother me, because that's not what they were set up to do. Mm-hmm. You know, that's not what their calling was. And when I look at somebody like that, that really goes, I just don't have respect for him running his business the way he should.
Do you blame Powell and his predecessors and maybe successors more than you blame Congress itself for reshaping them? I mean, the Humphrey Hawkins Act said,
Right.
here you have a tripart mandate, right?
Well, it's interesting you say that, because I do blame the Congress, because if they had taken fiscal responsibility all along since Greenspan, I think what they did is they punted to the Federal Reserve and said, it's not something they did intentionally, but it worked okay in the beginning, so they just kept on doing it. Mm-hmm. Hey, it's up to you. You know, the markets are falling and this is happening, so you need to take care of it. Mm-hmm. And oh no, they're worse. So yeah, they go hand in hand. But I think he's got a tough job. I wouldn't want it, but I do think he's overrated, because people they sit on every word he says, and it's like we just think that's not the way it should be.
Yeah. Next on my list, Stan Druckenmiller. That's a logical segue.
Yeah. Well, I have tremendous respect for Mr. Druckenmiller. I don't know him, but I know his track record, which is envious. I would love to have it.
Yeah.
You know, there's people that I look at and say, I wish I could be like that, and he's one of them. Really smart man. I've always enjoyed listening to him.
Is there anything in particular in his approach or his public utterances that you find particularly persuasive, compelling, or appealing?
Well, you know, recently he's talked a lot about this in the last 6 or 9 months, about government debt, about how it just can't work. I have to believe that. I mean, I think he's correct on that, and I just think more people should listen to him. If there's one thing I would love to do is, I would love, when he's making changes in his portfolio, I'd love to know what he's doing.
In advance.
Yeah, in advance, you know,
Sure.
or just at the
Good
same
luck with
time.
that.
I just love to know, hey, I'm thinking like this, you know.
Yeah. I mean, from what he's told publicly, sometimes he himself doesn't know in advance
Smart guy, though.
what the move's going to be. He sure is.
By the way, I've tried to interview him before, and I got shut out, but I'd love to have interviewed him.
Sequoia Capital, underrated, overrated, why?
Oh, I think overrated.
You should explain to our audience who they are, by the way.
Yeah.
You and I
Well, the
both know who
big
they are.
venture capital company, I guess, if not the biggest, one of the biggest. And all the startups, you know, and a lot of the things that you see trading today, they had some input into. I think what people don't understand about venture capital is you never hear about the things that don't work. Like a lot of our clientele will do something and I ask them, what are you doing? I'm going to venture capital. And I'll come back a few years later and I'll say, well, what happened? I said, well, they had 5 deals, 4 didn't work, 1's working okay, but they're never going to get the money out,
Mm-hmm.
And the thing about it, if you look at Sequoia, I think they got so big they thought, you get this idea in your head that everything you do is going to work. So they went into FTX and all that. Crazy.
Mm-hmm.
Overrated.
Yeah, my own view of that is the generalization is whenever you get a truly extraordinary outcome,
Mm-hmm.
which you did in the case of Sequoia's relationship with FTX,
Yeah.
it happened to be an extraordinarily ugly outcome.
Yeah.
It's always the confluence of a number of extraordinary factors, not just one. So you could say, well, failed due diligence, failed governance. It was all of those things. But to me, Ted, the ultimate underlying root cause of that debacle was what I call excessive asset aggregation, meaning they just had, because they had such a sterling track record, they aggregated so much capital that when SBF walked into the room and said, yes, I'm running a crypto exchange, but it has the potential to be the Amazon of finance.
Yeah.
They said, it was right in the article that was on their website until they yanked it down, their hagiographic profile of Sam Bankman-Fried. Said the reason we're writing out this massive check is because he's articulating a vision for a TAM, total addressable market, that it can absorb a very large amount of capital from us, which is, of course, their principal challenge because they had aggregated so much capital. What people failed to do is then go back, and this sounds a little bit impolite to my friends in the endowment and foundation community, as you probably know, 100% of Sequoia's client base, leaving aside its own principals and Silicon Valley execs from whom they took some taxable wealth, but all of it was endowment and foundation capital. And so you go back, where do you stop drawing the blame? Do you go back to the MITs, the Harvards, the Stanfords of the world and say, well, you failed in your due diligence to ask Sequoia if it was conducting adequate due diligence on FTX?
Yeah.
I don't know how far back you want to go.
Well, in that case, I think anytime you have a new fad investment, you need to be really asking a lot of questions.
Yeah.
Anytime it's a new fad.
Yeah. Well, in this context, you mean crypto, because
Crypto.
VC industry itself is
Not VC, but I'm
60
talking about
years
the
old.
crypto
Yeah.
side of the business. If you go to CoinMarketCap, is a website, there's 8,800 coins on
Yeah.
there, okay?
Yeah.
I just checked it yesterday. I was curious, hadn't done it in about 5 or 6 months. And all the way down to, I think, number 200 is still like $1 billion.
Yeah.
In other words, it tells you, and if you go look at how much, if you look at the amount of money that's been lost in that group, that itself would make you think, oh, we need to do a little more work on this before we let them go.
Yeah.
And I don't think they did.
Yeah. No pretense that there's this logical segue to the next bullet on my underrated, overrated list. The long-term return potential of ExxonMobil and other oil and gas majors. Overrated, underrated, and why?
I think it's underrated in this respect. I think people have misjudged the move from fossil fuels to green. I think they think that, oh, we'll just do electric. And they don't realize there's a lot of ramifications to that. Number one, there's too many countries in the world that they don't even have they don't have that much electricity. Number one, but I think
They have a lot of vehicles,
but mostly
ICE at present. Yeah.
And so I think people don't realize that the oil and gas business is probably going to be better than they think over the next 10 years. Is it a declining asset? Yeah, in the long, long run. But over the next decade, one of the things that I think they've done in certain cases is they've spent money on things that probably didn't need to be, but now look at what they've done. Chevron, look at the two, Chevron and Exxon both made major purchases. And the reason why is because they know they need that. They need the fossil fuel, oil and gas. And so I think it's underrated on what they can do the next 10 years.
Warren Buffett, underrated or overrated?
Oh, I think underrated because people don't really take enough of his. But what I say, for me, I think I love what he does. Okay, when I say underrated, what I mean is he's so much better than what people think. I think when I use that term, they just don't understand how good he is. I love the way he runs his companies. Go look at what he pays his board members. They have to own a lot of stock on their own. He doesn't give it to them. No stock options. They get paid nothing, $7,000 a year or something. He takes no money. I love the way he buys companies. You've got all these other companies that buy companies, private equity. They never use his model. He has the perfect model for buying companies, the way he does it, and yet nobody ever learns. I think he's fantastic.
You mentioned Japan earlier. Are you looking into? Do you own any of the trading companies that he's invested in? Are you looking at them?
I'm looking at all 5 of them. I think there's 5 of them, and I've had them all on the looking block now for about 3 or 4 months. And to give Hedgeye some credit, you've recently kind of backed down on Japan, and so I thought, I may wait a little while on there to see what's going to go on here. But that's what we've done.
Yeah. I am keeping a careful eye on the clock, and I know we've got to get you to JFK in a timely manner. If you don't mind, I gave you a forewarning, but I have done a lot of interviews like this over the years, and I have sort of 2 favorite closing questions, which I'd like you to answer in a total of about 5 minutes, and then we should wrap up to get you to the airport on time. The first one I call my grace under pressure question, and it's simply, as I think you know, what is the greatest display of grace under pressure that you've ever witnessed in real time, either in person or on TV, but replays don't count?
Right. Well, I'm going to answer it, but I will tell you I've watched so many cases of grace under pressure on just normal people that illnesses, or they were going broke in a business or something. They had tremendous grace under pressure, and I just, my hat's off to them, and I see a lot of that.
Which makes them not normal people, right?
Not normal
They're
people,
extraordinary
right.
people.
They're extraordinary people.
Normal
and
by
they have
conventional
they
standards.
have something about them that's able to do that. I'll answer that question. I have to think about it. But when I was around 12 years old, I was watching the Birmingham riots, and I don't know if anybody remembers it, but
you were in North Georgia.
at the time I was in Texas by then.
We
got into Texas, but in watching that, I don't people realize, but Martin Luther King got thrown in jail, and so they were showing that. But then all of a sudden, thousands of kids left schools, and they didn't loot, they didn't burn, they just were trying to get, equal rights.
Yeah, nonviolent protest. Yeah.
And they were completely nonviolent. And if you watch that, you think, how do you take a group of that many kids and keep their cool when they're getting blown out with hoses, beat up, and everything? And I always had that always struck a place in my heart for them, and that's just something I always noticed.
Yeah, it's interesting. I think we could both agree King's letter from the Birmingham jail is one of the great pieces of writing in human history.
Yeah, he's written some interesting things.
It's extraordinary.
Yeah.
So my other question, I call it my Mount Everest question, because as you know, I was reading Into Thin Air when Krakauer published it about the debacle on Everest. I think it was in 1996, and I said to myself, not the Sherpas who tragically died, but the really wealthy patrons of the Sherpas who were on the mountain and they themselves died. I thought, to a person, they wouldn't be there if the universe had a rule that said, once you get back from Everest, assuming you make to the summit and return safely, you can never talk about it. In other words, it was their ego that was driving. So the Mount Everest question that I've posed and had a lot of interest in doing so over the years is simply, what is the single feat, F-E-A-T, that you would be keenest to accomplish, subject to the all-important condition that no one would ever know that you'd accomplished it?
Well, and pardon me if I read something into this, but I assumed it didn't have to be something that was physical.
No, of course not.
And so for me, that's an easy answer for me. If I could financially and emotionally affect every foster child in the United States, I wouldn't care if anybody ever knew about it.
Yeah.
That would be my feat.
Yeah. Let's take one more minute to talk about, it's remarkable to me and commendable what you've done with foster angels. Just describe for the audience, and I'm going to encourage folks, because I think it's a worthy cause, to maybe support it. So let's finish
Well,
with
we have
that.
2 foster angel foundations, both in Texas, one in South Texas, one in Central Texas. They're different foundations that I started, but we help between the 2. We have about 10,000 kids a year. Wow. And I will say this to everybody out there, that foster kids have it rougher than anybody.
Yeah.
And I know they do. And what we decided to do was to make sure that whatever they wanted to help their self-esteem, we provide it in 48 hours. And that's what we do. And we turn a lot of lives around. Now, you know, you're not going to turn everybody around, but if I can affect, and we can affect life of a kid to just improve their self-esteem, that they really say, you know, somebody cares about me, then we win.
Okay, so to just get the nail flush to the plank, people Google like foster angels.
Yeah, just foster angels of Central Texas.
Right.
It's
501c3.
Yeah, 501. Both are 501c3s. One South Texas, one Central.
Awesome.
They're both fabulous. We got fabulous people in both. And by the way, we get most of the money to the kids. Yeah. You've seen that before too.
Well, Ted, you have important work to do in Texas, among other things, foster angels. So thank you for making the trip. We'll let you get back down there. And really appreciate you coming by to talk to me.
Glad to be here, and you know, I have a lot of respect for Hedgeye. I love all your work.
All right. Thanks, Ted.
Okay.